Hey guys, I would like to talk about SCHD. So you can buy one share at $73.43. Um, this NAV, that means net asset value. So if you own something that has a NAV, sometimes you will be buying it at a premium. Sometimes you'll be buying it at a discount. And this fund was started, I think, back in 2011, and it's done good. If you know the last 10 years or so, I mean, you basically, if you bought at 25, you would have tripled your money, plus all the dividends you would have got in those years. The PE ratio is manageable. It's below 15 at 13.93. Of course, the PE of 10 would be a 10% return. If you want to know what I think the return for this is, divide 1 divided by 14, and you'll get that is less than 10. But they got a good yield, and so they're paying a dividend. And I was watching this guy named Ryan Williams. I really don't know the guy. I really haven't watched that many videos of his, but he was suggesting, or he was saying, you could just have a portfolio of just VOO and SCHD and have a 50-50 split. And the benefit of that would be you're getting a higher dividend from SCHLD than you would be. You're getting a closer to a 4% return, whereas the VOO you're getting less than a 2%. And you got to take this expense ratio. Now, VOO, this would be something like Warren Buffett recommends, and just stick 90% in VOO, a low-cost index fund, the S&P 500 index, the 500 biggest companies in America, and then short-term Treasury bonds, 10%. But when you buy VOO, this is basically what you're buying. You're buying the 500 biggest companies of America. This is Berkshire Hathaway, Microsoft, Apple, Amazon, Tesla, Google. But probably 20% of what you're buying is basically these big companies, because their market cap is so big. But you can look and see what they're actually invested in. This is the actual thing here. Of course, this is UPS. I don't know what some of these are. This is Pepsi. I think that's Texas Instruments. Coca-Cola, KO. I think that's Chevron. But this is the actual breakdown of what they're invested in. These are just showing the top 10 holdings. So they got Broadcom, they got UPS, they got Texas Instruments, Home Depot, Pepsi, Cisco Systems, Amgen, Coca-Cola, Chevron, and Verizon. And Verizon, I think, had taken a big hit. What was it, last year? They were down pretty substantially. I want to say maybe they got cut in half. I'm not sure. But anyway, this is how they got it broken down. And you know, the portfolio managers, they like to do things like this. Oh, I got 17% in industrial, 16% in healthcare. You know, this is a bunch of bullshit. You know, a bunch of BS. You know, just buy 10 good companies that you think will be here in the next 100 years, and 5 companies, 4 companies. You know, you'll do good. You'll do okay. But what I want to show you is basically what this guy came up with, and I don't know if this is accurate, but I have no reason to dispute what he was saying. But basically, SCHD is trying to mimic VOO. The benefit for SCHLD is they pay a better dividend, but the downside is they also have a higher expense ratio. They have actually a double. I mean, these are the lows, 0.06, and VOO is 0.03, but the expense ratio is basically double the expense ratio of this. Now, if you're dealing with small amounts of money, you know, what I mean, that's almost a 0.06 is getting close to 0.1. And guess what? You know, and that means, you know, how much money are you losing over the course of a long period of time? And you know, if they're taking $1 out of every 1,000, you know, that's not a big deal. But you know, imagine over 40 years, you know, them taking $1 out of every 1,000, and then, you know, your portfolio is $2 million. Well, you know, that expense ratio could matter. But this is basically what I wanted to show you is the share price for VOO and SCHD. You invest $1,000, you stick $500 in each. The annual dividend is $2.60 for SCHD, and then for VOO it's $6.20, which gives you a 1.54 dividend yield on VOO and a dividend yield of 3.62% on SCHD, and you average those two together, you come up with 2.58. And I forgot what CAGR stands for, but it's like the growth rate. I wouldn't pay that much attention to this because it's probably wrong, you know. like I said, the economy around the world is shrinking. It's not expanding. It's shrinking. The birth rate is negative. Um, the debt is at all time highs on every country in the world. Um, the U.S. is. You think the U.S. is bad? You know, the U.S. is like the best house in a bad neighborhood. And you know, China is really bad. Japan is bad. Europe is bad. You know, like we're just the best house in a bad neighborhood. But everyone is over indebted. We are putting a burden on our kids and grandkids to pay for our debts, which is a travesty in itself. Why can't we get to a balanced budget and create a surplus for our children and grandchildren instead of making them pay for our bills that we can't afford to pay? But anyway, if you own these two and got $500 in each one, you should expect that you would probably get $25.80 after the first year that you're invested. Now then what you do is you reinvest this $25 and $12 and something goes back into this one, and then $12 goes back in this one. But anyway, we fast forward 30 years. And like I said, this right here, you're creating assumptions. And like I said, the reality is the return is actually going to be negative, probably. It's not going to be positive. It's going to be negative. That's why I think it's better to invest in individual stocks that are undervalued instead of buying the market. Like I said, for the average person, if you just know nothing, just buy the market. You'll be fine. You don't ever have to look at stock market again. Just every week, put in $100, whatever it is. You'll be fine. But to me, if I think that BOO, and the reason why I liked Berkshire Hathaway a couple years ago, well, this was back when the pandemic hit. Berkshire Hathaway actually beats the market historically, and they were trading at less than $170 a share at the time, and you got VOO, who basically is was trading at 350 or so. Now it's over 400, and so like if I had to choose between Berkshire Hathaway and VOO back then, I definitely would have chose Berkshire Hathaway because they were trading at half of what VOO was trading for. But this is assuming, and guess what assume means? It makes an ass out of you and me. But let's assume an average annual return of 6.63%. I mean, you're getting basically half of that just from dividends. So you're assuming that the inflation is 2% and maybe the world's growth rate is 1% and or whatever, and anyway, you come up with 6.63. Well, if you invest $100, I think this was assuming you invest $100 every month for 30 years. I mean, I guess you started with $1,000 and then you invest $100 every month for the next 30 years. basically your annual dividend income would be $50,000. Is basically what this is saying. And you also have to reinvest those dividends. But then he used an example. Let's say you invest $200 a week instead of $100 a week. You invest $200 a week. Then you would almost have $100,000 in annual income, which is nice. But the problem. This is the risk I see. Number one, is this going to be here in 20 years? Is this going to be here in 30 years? I don't know. It may not be. And what happened with a lot of people who owned, say, SPY or whatever a couple years ago was whoever was managing the fund had sold some stock. So guess what happens when you sell stock? That creates a taxable event, and those people that owned it, they owed a big tax bill because they had a big capital gains. So that's a risk too. Now, in America, you had the baby boomer generation, and the baby boomer generation was the generation that was born right after the war. And there was a massive amount of children born. And now, today, those baby boomers are retiring to the tune of probably $8 million a month. And there's not another generation that can compete with the amount of consumption that the baby boomers did. 40 years ago, you had all these, families buying their first set of diapers and their first cribs and their first this and their first that. And there was this enormous consumption by this generation. But the subsequent generations are much smaller. And I can tell you that the person reaches their peak earnings probably in their early 40s, and then they start to decline. When you buy your first house and your first car, and you're spending all this money, and then once you have accumulated all that stuff, there's no need to go buy another hammer because you've already bought the hammer. There's no need to buy another rake because you got 10 rakes in your garage. But basically, there's all these people. There's probably 50% of Americans that are on the 401k plan. And what happens is every week when they get paid or whatever, a certain amount, maybe 5%, maybe 3%, and you may pay 3%, and your employer may pay 5%. So 8% of your salary is now invested in the S&P 500 index every week, and it's just automatically drafted. And half of Americans were doing that. Now, a lot of jobs don't pay a 401k, or they don't say anything about the stock market, and those people are the ones that really need to invest themselves because their employer is not doing it for them. So, you got to take charge of your own financial journey and growing your own financial wealth. Don't depend on the government to do it for you. The government's broke. The government's been broke. The only way the government gets money is by stealing it from you. But here is the risk that I see in the S&P 500 index. As these older people retire, they're going to have to sell their 401k, their investments in VOO, in the Vanguard S&P 500 index to live. Now, as we know that the average 65-year-old in America only has 100K to retire, and they spend $50,000 a year. Social Security is $30,000, so there is a $20,000 hole that they have to make up. Now, they can either downsize and get a smaller house. All their kids are grown now. You don't need a big house anymore, unless your kids are worse off than they are and got to move in with mom and dad. But a lot of these people are going to have to downsize. A lot of these people are going to have to work till they're 70, till they're 80, till they're 90, till they die, the day they die. They're going to have to start eating beans and rice. But one thing they're going to do is, I think at some point, they're going to start taking at least 4%. The 4% thing was, let's say that you get a 10% return on your money. Well, in theory, you could take 4% out every year of your money, and you would never run out of money because it was growing at 10%. And I really don't like to use the word growing because down here they have a little thing of value and there was a chart somewhere like value versus growth or something. Like, look at this crap. Like, this is bullshit. Like, this is stupid. Like, it's not value or growth. You can have something that is undervalued and then that company is still growing, so you're getting both. You're getting both value and growth. It's not one or the other. And like I've said before, in a competitive environment, let's use the car industry for example. When Ford dominated America and basically everyone in America was given a line of credit to have a Ford vehicle. And what happened? You had all these companies from Europe flood the U.S. markets with cars. You had other car makers in America flood the market, and then eventually, when there's no profit to be made, they stop coming. But if someone is making an exorbitant amount of money in profit in a competitive, in a monopolistic industry, the competitors, if there's low barriers to entry, will keep on coming until they have eaten up. They eat up some market share until Ford no longer has a 30% or 50% profit margin. Their profit in most grocery stores, their profit margin was 1%. And but in a competitive environment, growth has zero value, and growth could actually have a negative value. In a competitive environment, the value of growth is zero. So I hate when these idiots on TV talk about growth when they have no idea what the hell they're talking about, because growth has zero value. Let's say every year to keep every year Netflix, let's say, to keep their 10 million subscribers, they have to spend $100 to keep those subscribers. And then let's say Disney, they got to keep their subscribers to Disney Plus. They got to pay $100 to keep their million subscribers. And and let's say some new company comes in, and let's say they're willing to pay $500 to get one new subscriber. And so they might penetrate that market, and they might pick up some market share, and they might steal away a Netflix customer from Netflix. They might steal a Disney customer away from Disney, but they have a high cost to that customer switching over. They're paying $500 to get that acquisition of that new customer. Now, let's say in 10 years or 20 years of them paying $10 or $20 a month for their subscription, they eventually have got their money back. But if they pay $500 to get that new customer or subscriber, and they leave and go back to Disney or go back to Netflix before they have recouped their costs, that growth, everyone loves the word growth, has a negative value. But in a competitive environment, the growth has zero value. So it really angers me when I see stupid stuff like this, growth versus value. But look, they even got the P ratios up here, 22. Well, what's the average S&P 500 PE ratio over the last 100 years or so? It's been 14 or 15. 22 is high. A 20 is a 5% return. So if you're paying trading at 22 times earnings, imagine you buy a beach house and you for $200,000 and you rent it out for $20,000 a year. You get your money back in 10 years. Well, in this example, it's going to take you 22 years to get your money back. You're putting money up today, and you're not getting it back for 22 years. Now, 22 years from now, everything after that, yeah, you're in the money, you're in the profit, but my assessment is if you invest today in the S&P 500, you're going to have a negative return. You'll still get a dividend, and you'll be able to reinvest that dividend and pick up more shares at a lower price. But buying at 22 times earnings is not a good deal. You're paying a premium, and out of your 2% return, that's from dividends, less than 2%, 1.5% return from dividends. The other 3% return is going to be from stock appreciation. But I'm not confident the stock is going to go up. My prediction is it will go down, because and I kind of got off on a tangent, but I says, what does SCHD do for a high dividend? Uses fundamental screens, cash flow to debt ratio, return on investment, dividend yield, and dividend growth rate to build its portfolio. The dividend growth rate is basically, all right, like this year, all right, this maybe Coca-Cola pays you 1 cent per share. Then, next year maybe they go 2 cents, and then next year they pay 3 cents, and every year it goes up. Jake doesn't focus on quality companies with sustainable dividends. As such, this approach gives the fund a modest large cap tilt and excludes REITs exclusively. Now, what is a REIT? A REIT is real estate investment trust, and REITs by law have to pay 90% of their income back to the shareholders. So if you do, let's say you do make a portfolio of something like this where you do a 50-50 split, maybe you put 10% in real estate, or 20% in real estate, and that would help your return. Like I said, like Maine, for example, has I think like a 5.7% dividend. And it's monthly, so it's more like 6.7 or 6.8 because instead of paying once every 3 months, you're being paid every month. So if you reinvest those dividends every month, you're compounding at a faster rate, and you're actually getting more yield than it even says. So if it says a 10% yield, you're really getting 11%. But yeah, I don't know exactly what he used for these numbers. I'm assuming he used $1,000 and did $100 a week, so that'd be $400 a month, and then after 30 years, and then he did one with $200 a week, which would be $800 a month over 30 years, and I think. The first example you have $1 million, and the second example you have $2 million. So, but back to the point I was going to say. All right, well, let's say you're a baby boomer, and every month that you've been working, they've been pulling out 8% of your check every month and investing in an S&P 500 index. So that means every month somebody is buying this ETF. They don't care if the ETF is high. They don't care if the ETF is low. No one is telling them this is cheap or this is expensive. The reason you're paying almost a 0% expense ratio, or very close to zero, is because nobody is managing the fund. Really, there's just it's just buying it's just buying whatever at whatever price, and there's no human that's saying, all right, hey, we got to hold off on buying Coca-Cola. Coca-Cola is at a 30-year high. Hey, we need to be careful about buying any more Tesla. Tesla has gone up 50x in the last 2 years. So they don't care if they're buying when stuff is cheap, or they don't know whether they're buying stuff when it's expensive. All they know is every week or every month, or when Bob gets paid and he puts 3% in of his money, and the company does a 5% match or whatever, and 8% of his paycheck is going in the VOO every month. And you got half of the Americans around the world doing the same thing. All right, well, what happens when the baby boomers get old, which they are now, and 8 million of them are retiring every month? Well, there's no longer anybody buying VOO. And what happens if there's a market crash and nobody is buying it and everybody is selling? And people are panicking because they have their whole life savings in VOO or SPY. SPY is even more expensive than VOO. But I like VOO better because it's cheaper. VOO 413, SPY 449. Now I will tell you the net asset value is 449. I don't know. The net assets of this one is 422 billion, and the net asset value is $449.62. So if you buy it at $449.70, you're paying an 8 penny premium to what the net asset value is. This one, the net asset value says 413.11. And this says this net asset is 887 billion. But my fear is this. Let's say you're 65 years old. Let's say you have $100,000 in your 401k, and your 401k is predominantly the S&P 500 index. And let's say you're ready to retire and you need that $100,000 today. So what you're going to do is you're going to sell your VOO. You're going to owe taxes on that position. Let's say you had a 500% gain. Well, you still got to pay taxes on your capital gains. So at the end of your 100,000 looks a lot like 40 or 50,000, and then something happens, like there's a tsunami or some natural disaster, or a volcano explodes, or there's a World War III, or something happens and people start to panic. And when people start to panic, people start selling. And or let's say the value of their stock drops in half. Well, people panic then too, and then it'll go down to 75%. And then maybe 85%. So instead of $100,000 in your account, you get 15,000 because you just lost 85% of your money. Not really, but only if you sell. If you sell, you've lost 85%. If you just hold on and don't panic or buy more, eventually, sometime in the future, you will recover your losses, and it will go back up. But human nature is people will panic and they will sell. And what happens when everyone is selling and there's nobody buying? Well, my fear is it could technically go to zero. Now, how's that possible? Well, if you got nobody buying something and you have everybody selling, it just keeps dropping and dropping and dropping, and it drops by half, and then it drops by 75%, then it drops by 85%, and then maybe some investor with a lot of money might buy a little bit. The government might buy some, and maybe it'll go up 20%, and then it'll drop right back down again. But so that is my fear with ETF, and I'm not going against one of the greatest investors ever here, but I just want to point that out as it is possible. It is very possible that this thing could go to zero at some point. Because, like I said, if all the baby boomers are retiring, and there's 8 million every month, and and over the next couple years, and then they're done. There's no more baby boomers. They're all dead and gone, or about dead, or they're out of the workforce. And there's not going to be enough people buying. There's not enough population that are buying the stock to make up for that lost baby boom generation. So the stock, in my opinion, will go down. And like I said, most of the baby boomers who own this stock will need that money to retire. And most of them won't ever retire because they can't afford to. But anyway, thanks for listening.